Hey guys, so unplanned video here. I actually was not intending to make this video, and then I got a comment on, it was on the R options, so the Reddit options thread, and they were just saying, hey, the market's going to plunge tomorrow, and the reason is because the death limit, there's going to be over 1,000 deaths in a single day, and I was like, I don't think the market's going to react to that, leastwise not the way anyone's expecting. And that is really terrible news, and I don't want to sound insensitive or anything, but the market looks at the future risk and tries to price in as much future risk as possible. Like everything it knows, it's trying to account for that. And that's just because you've got millions and millions and millions of investors and thousands of companies all investing, and they want to make money, and they don't want to take more risk than they have to. And so anytime there's going to be extra risk, those securities are going to get repriced immediately to account for that risk. And options are even more sensitive because they're so highly leveraged. The market makers are themselves also they use implied volatility to determine how much implied movement there's going to be in a stock. And the cool thing with Tastyworks, you can actually see the expected move. So right now the expected move in SPY, they're expecting it to move between 253 all the way down to 215. So right there, that's about 38 point move downward, and then from the 254 they expect it could go all the way up to the 292, which is let's see, 292, sorry, I should have done this ahead of time. So that's a $38 move up as well. So did I do the first one right? 253 minus 2, yeah, $39 move. So that is the implied volatility. It just plopped right in there and stuff. Now, the interesting thing that I was looking at is if you sell the 36 delta call compared to the 36 delta put, there we go. You're collecting $24.53. That's per share. So that's actually, you're collecting $2,453. In the next 47 days, they're expecting, this is the 47 days out. So the stock market there is expected to be within 214 all the way to 293. So it's going to be within that range. By selling these, look at where my profit line is. Like, I make money all the way out to 215, even if this is in the money. This is at expiration, of course. So if it expires above 215, even if my puts are in the money, I'm still taking money home. Like, I'd still be, bringing money home. And same on the other side. If it expired like below the 296, so this gives me more upside protection than downside protection even. And what that tells me is the market, even though the market itself is about equal, the implied volatility and the pricing on calls is skewed slightly higher than normal. And so they're expecting more of an upside move, which means that they've priced that into the options, and that gives you a little more room on the upside to be correct, even if you're wrong directionally. Which is why I sell options and I don't buy them, because you've got much more flexibility. If I'm not comfortable with being this close to SPY, I can sell I can go ahead and sell myself a 25 delta trade. Let's see, 25. And is that 25? 25. Yeah. So the 25 delta trade moves my profit zones even further out. Now, granted, I'm collecting less money. I'm not collecting nearly as much. I'm only collecting 1555. So that dropped in about, what, $700 of collection. Now, the interesting thing, let's move it back to the 36 delta. So I'm collecting $9.56 on that. And for the 36 delta on the put side, I'm collecting $14.84. And that's a pretty big difference. But normally, so that's $9 to almost $15. Normally the puts are twice as expensive as the calls. So puts are usually sell for twice what you'd be selling the call for at the same delta. So the calls are a little bit more expensive, just like I was saying. And just because there's usually more downside risk in the market. But this market is saying, hey, we've had a lot of downside movement, so we think that there could be some upside movement. And we want to make sure we're prepared for that, which is why they're inflating the prices of calls. Now, the last interesting thing to me is how far away this 36 call is compared to the put. So the put, let's see, so 253 minus 239. So the put's 14 strikes away, whereas the call is like 19 strikes away, I think. Yeah. So the call's 18 strikes away from the money. But it's got the same exact delta, which should represent roughly the same probability of SPY reaching that ticker. And I actually pulled up the out of the in the money percentages. I can do out of money. So there's a 57% chance that SPY is going to not reach 239 at expiration for this trade. And then for, let's see, here we've got a 70% chance that it will not reach 272. And I think that's just because how far away this call is compared to the put. And I just found it really interesting that the market is saying one thing, but I think a lot of traders on our options and small street bets and everything aren't familiar enough with the Greeks and option pricing, and they haven't seen enough markets to or necessarily placed enough trades to understand and notice this. So I noticed this for the last week as I was placing trades, and I didn't really it was more of a gut thing, but yesterday and then this morning I was actually looking at the numbers. I was like, well, let me actually look and see what they're pricing the calls versus the puts, and see what the skew is and which direction the market is leaning. And right now the market is leaning bullish slightly. They're pricing in more risk to the upside than the downside. And the downside is still more expensive, yeah, but it's relatively less expensive than in a normal market. So I just wanted you guys to know that going forward, you want to be careful if you're going to be buying puts. I'm happy to sell you puts. I like selling options. And I do buy puts to hedge my short puts. It's going to be a very interesting. This next several weeks is going to be very fun trading. Let's just put it that way. It's going to be fun trading. It's going to be up and down all over the place. I've been telling you all week, last week, I totally expect the market to. There we go. Yeah, I expect the market to start trading sideways, and if it keeps going down, it'll go down a more like at a more measured clip. So, because the market's already priced a lot of this coronavirus move in. At this point, it's just the fallout, and anything else is just going to be additional like information for the market to digest and be able to adjust. Okay, so we corrected 35%. Oh, now it's probably at 30%. We corrected 30%. Now let's like adjust things and figure out where the true bottom needs to be before we can start recovering. So right now it's just testing this area to see if it likes it. So I think the market's going to bounce around, might trend down slightly, but both myself and the market makers are worried about a big spike up in prices, like a big move up. So, and it could be a gradual move, but a gradual move I don't care about. I can deal with a gradual move. A big spike up, I can't, my portfolio is not going to handle that. Like, that would suck, to be honest, because I'd be simultaneously down. So I lost like a couple $1,000s when it came down here, and I'm starting to make that back. But if the market spikes up, that's going to be another, for me, that'll be another like couple $1,000s if I'm not ready for it. So I've actually, my IRA, it can handle a modest spike up right now. That'll actually help recover a lot of the losing positions that are just kind of locked in. And my individual account, I've got positive 10 delta. It can handle a little bit of a up move. But what I've been doing is putting on a lot of, in SPY. So I've been putting on like, this is $1 wide, and this is a $5 wide. And I was able to collect more than $100. So even though this is in the money, I'm actually not losing any money on this trade, because I collected over $100 on the initial trade. I collected there you go. I collected $162. And then I rolled up my puts actually, so I've collected actually $193 on this trade. So if this expires in the money, I keep 93 cents in profit on this losing call spread, just because of how much I collected with the whole trade. So I'm structuring my portfolio so I have almost no upside risk in my margin account. So, yep. And if you guys, I would just recommend doing that too, because this 35% down move in a month is the fastest down move since like, I think it was like 1935 or something I was reading, which is almost 100 years, guys. It's like 90 years, no, not 90, 85 years, I don't know. It was like between 85 and 90 years ago was the last time they had a down move this fast. So this does not happen often. And like this is like a once in a lifetime opportunity to trade in the markets. So, I hope you guys are enjoying it, taking advantage of it. It sucks that it's because of this pandemic and stuff, but the volatility is there, and gotta take advantage of that volatility, man. Anyways, so I just wanted to chat about the markets, talk a little bit more about where I think it's going, and explain why I think it's going to do that, and back that up with some numbers so you guys can see my perspective and why I position my portfolio the way I am. Anyways, thank you very much for listening. Have a happy Sunday, and may the option trading go smoothly for you guys going forward. Ciao.